Buenas tardes a todos.
Good afternoon to you all. Welcome back. Welcome. We have to say welcome again when we open every session, because you know that this is being recorded. So this is the doctoral seminar of the 5th European Award-Marcelino OREJA, and the title of this seminar is the European Projects, Modernization and Governance in a Plural Framework with Shared Values and Goals. So after the networking over lunch, the work this morning, we know that this is a very complicated point in time in the day. So Javier, you have a challenge ahead of you, but I think people are really eager to listening to you. So we have Javier Esteban Ríos, who will be talking about the banking union, and he will be talking about the banking union, enlarging the gap between the two Europes. So, you know, the mayor of Quackers talked in his speech about the populated Spain and the banks that were abandoning the villages and the small municipalities. But first of all, I want to give the floor to our dear director and friend Jürgen Elbert, because I'm not going to introduce him because he's been with us already for since yesterday, and he already introduced them.
When I listened to the papers of the morning session, and I want to thank all of the speakers of this morning due to the contents of the papers given, very interesting and showing the wide range of of the state of affairs of European integration right now in the moment with all its complexity. I was reminded on the very beginnings of the integration process, shortly after the Second World War, when at least the countries west of the Iron Curtain tried to find another way of cooperation. And several attempts had been made, we all know of them. The Marshall Plan, for instance, the Council of Europe concept. Both these initiatives had been undertaken because the politicians in charge wanted to create another form of cooperation of nation states. But as we know, it didn't work that well. So it was Jean Monnet who developed another concept and who said, well, if politics don't succeed, we try it with economics. We try it with the economy. And in the end, they created the European Coal and Steel Union as a first attempt, as a kind of test run for the European integration process. And the treaties of Rome, were signed at first sight as a kind of, commercial treaty as well, because it was about creating the European economics community. But the basic idea, or the idea behind these two attempts, had always been much more than just economy. Sorry for saying just economy, but because we all know it's the economy stupid, you know, so it's the economy as the driving force behind everything. And that's the case with the European integration process itself, you know. Economy was chosen as an element to create a political union and a union of values, although the value question, as we have heard here, is definitely not settled yet. But I'm very happy that we also consider economics in this case with regard to the banking union, which leads us, for instance, to another crisis in the series of crises of European integration process, the commercial crisis of the first decade of the 21st century. And in one paper I wrote, let's say 15 years ago, I developed the thesis that it has been the crises that actually worked as driving forces behind the integration process. The European integration area, at least with regard to the crisis I had in mind then, always went out of these crises stronger than before. I'm not quite sure whether the situation as it is right now will end in the same result. Hopefully it will. Being optimistic, I'm right now confident that it will in the end, although it's a long way to go. But let us take this example. You know, we had this commercial, this financial, this banking crisis, and in the end, out of all the chaos emerged at least the attempt of getting financial policies within the Eurozone and beyond closer together to find certain arrangements and settlements to improve financial cooperation within the Eurozone. And I'm very happy to introduce to you Javier Esteban Ríos from the University of Zaragoza, who is going to speak to us about the banking union enlarging the gap between the two Europes. That's a crisis within the title again, isn't it? Okay, but anyway, Javier, you've got the floor.
Bueno, muy buenas tardes a todos.
Good afternoon to you. From what has already been said and what Miguel Ángel said, I have to try and prevent you from falling asleep. I will try to make my best, but I'm not sure to succeed. I thank the foundation to be here to talk about some of the conclusions of my research. I would like to thank all the issues of the organization of the seminar and allowing me to participate here. I'm going to speak about the banking union and the impact it may have regarding the integration of the different member states. I will follow several stages. First, I will talk of the banking union and the different components that integrate it. Once we define them, I will analyze which member states are under this banking union. Not all of them are integrated in a compulsory manner. Some states may accede in a voluntary way. We will analyze pros and cons that should be taken into account by a member state, whether he decides to join or not. Some factors will be analyzed on how they can condition the decision, and they will depend on each particular state. If I have time, I will refer to some perspectives for the future, some reforms for that banking union to be more attractive. The economic and financial crisis in 2007 would invite to reform banking institutions, as the present model that was not viable. There were trends or supervisory policies which were quite lax and would aim at favoring their own national banking systems. There is a progressive diffusion of the banking crisis. It is communitarized, the process of the banking union, so something that affects one state could affect the others. So a crisis may have happened thousands of miles away from that member state. It shows the crisis the need to resort to public funding. This is something that accompanies all the processes. Some data in the EU between 2008 and 2017, 665 billion euro of public funds were contributed, 5% of the gross domestic product. If there is a transfer of liquidity, 2 trillion euros would be the figure, which is absolutely mind-boggling. The amounts that are recovered from those contributions is minimum. An example is Spain. It is estimated for the time being that we will be able to recover an amount of the funds which is estimated between the 20 and 25% of the funds contributed. So losses of some 64 billion euros, 42 billion from the FROB, and the other one from the private sector, 22 billion. This means that capitalization of the banking sector are not for free. They cost directly for citizens. So from 2012, in June 2012, the union institutions and the member states agreed to act on the banking system to try and tackle these problems. So they create a mechanism of the banking union, which is the most important change in the financial integration since the creation of the euro, both for the depth of the reforms as for the importance of the sovereignty that is relinquished by member states to the union. In order to have a slight idea of what the banking union is, it can be seen as a sort of building, some pillars which are on the basis of foundations. The foundations would be the single normative code, and on those we will have 3 pillars: single supervision mechanism, single resolution mechanism, and the European system of guarantee of deposits. I will try and analyze each of them so that you can have an idea of their structure. Regarding the single normative code, it represents the foundations of the rest of pillars. What is it? It is a series of norms, centralized and harmonized, that tries to put an end to the dispersion of certain documents which led to asymmetric situations between member states. This single code has 2 elements: the Regulation 575/2013 and the Directive 2013/36, which has been already passed on to the national legislation. There are other norms to develop them. Delegate mandates from the Commission, etc. This code is not only based on regulations, but also guidelines, indications that are created by the banking authority in order to be applied homogeneously by national authorities, because from there could be diverse interpretations of the norms. So this banking authority would have single criteria in the application of the norms. Before finishing, it is a possibility, an innovative possibility, which means the possibility of formulating by the national authorities or to consult the European authority, banking authority, to try and find out the interpretation of the norm. So both the operating agents and the normative supervisors can have a say in that. It is published in the page accessible of the banking union. There would be a supervisory element as well, which tries to tackle the divergent application of norms in different states. The difference here doesn't, or the solution doesn't come from norms, but from an institutional approach on who applies the norms. Supervisory competences are given to a central authority, the Central European Bank. It is regulated in the Regulation 1024/2013, which is developed in 468/2014, which entered into force the 4th of November 2014. It has a certain itinerary already, or background. The main innovative element here is the fact that the supervisory competences exerted by the Bank of Spain, for instance, in the case of Spain, are transferred to a central authority, the Central European Bank, which from then on will exert supervisory policies on entities, banking entities. Which are the entities? Those, all or just some? When the regulation 1024/2013 was approved, there are different interpretations. There's France or others that are in favor of the bank intervening in any of the entities. Others, for instance, Germany, wish to control the at national level smaller dimension entities. The Central European Bank only supervises the biggest dimension entities, those that are significant, those that have certain requisites. Those that are not significant and which do not put into risk the system will continue to be supervised by the national banks. What are the criteria to know whether they are significant or not? There are many. Size, if they have more than 30 billion active assets, the importance of the bank for the country, if it has more than 5 billion and more than 25% of the GDP, and in other cases, if it has more than 20% of the GDP and 5 billion, according to the stability mechanism, it will be considered significant, and the three biggest entities in any member state. Due to those criteria, the Central European Bank will supervise approximately 80% of the assets, banking assets. In Spain, it's even higher, 96% of the total assets. I think this is significativity, if one can use that word. It is assumed on a good number of entities by the Central European Bank. In Spain, for instance, Banco Santander or Ibercaja or Unicaja of Malaga, for instance. Apart from this supervisory mechanism, we have another single resolution mechanism, which intends to have common criteria to deal with restructuring the entities in crisis, and to control the public funding to those ends. A central board in the EU will take care of this in the first goal. The idea of not allowing the use of public funds instead of the bond owners and other investors would have to accuse certain losses in order for them to act. There is a mutualization of risks as well. Up until now, the funds to assist entities were purely national. From the creation of the single resolution mechanism, which entered into force in the 1st of January in 2015, funds are global for the whole group of states. With contributions from the sector, it will be 1% of the deposits guaranteed in the Eurozone, 55 billion euros. Some authors say that would not be enough for crises such as the one that we have lived through. Be it as it may, and I said that this mechanism entered into force on January 1st, 2015, it has transition periods which are sometimes up to 8 years. Mutualization of risks will be only full in 2024. Until then, the funds that are contributed are integrated in the national compartments that are are merged throughout the years. This single resolution mechanism has a third pillar, the EU Deposit Insurance Scheme, which mutualizes risks and unifies coverage. There are expectations from the Commission and estimates that speak of 2024. They may be too optimistic. There are proposals in 2015, but member states have not adopted them. For the time being, then, the deposit guarantee system are only national. They respond to the claims of the depositors that have been authorized in a particular member state. What happens? There is a certain level of harmonization in the Directive 2014-49, which gives some thresholds that have to be fulfilled by any member state. Perhaps you remember the coverage of 100,000 €100,000 guaranteed by entity and by person or investor in their accounts. Mechanisms and structure. Which members are in the banking union? Are they all? Are they only a part of them? The banking union is born with a limited extent, not to all members. There's going to be a dual system. Some, the ones that have the euro will enter compulsorily, others will adhere only voluntarily. The ones that do not have euro as an official currency. Why this regime? Legal restrictions is the cause. It derives also of the implementation of the single supervisory mechanism. That is the one to be would enter into force in 2014. The idea is that all the same block of states should work in a harmonious way. The configuration of the first pillar will condition the rest of the pillars. Has been said that the banking union is conditioned by the subjective mechanism of the single supervisory mechanism. What are the conditions for that? The legal basis chosen to cover it. The article 127.6 is reproduced here. The possibility of giving competences, specific competences to the Central European Bank, which will require unanimity from the member states. Is this licit, the application of this mechanism and the legal basis of it? They are very diverse. The competences of the Central European Bank, requirements of information, the series of competences means that it would assume more than specific tasks, going beyond the limits of the treaty. However, there may be an interpretation of a formal nature that would cover this assumption of competences, since the Central European Bank does not assume all the competences, but specific tasks, not all. As I said, minor entities are supervised by national authorities, and there are some procedures, authorizations, significant participation where there is a cooperation between the Central European Bank and the national authorities. I can give too much information and probably I don't have. No, I can't. As I was saying, this legal basis, even if it is questioned when the court the Court of Justice has validated this point. For instance, in the Landescredit Bank of Baden-Württemberg, which is a way of recognizing the supervisory competences, which are under the exclusive competences of the ECB. So it has cover, this supervisory cover, particularly solid. On the other hand, Article 126 for political reasons, so Article 127.6 intends to assume competences by the ECB, limited restrictions or controversial issues at legal level, and then there is a specific procedure to assume competences which allowed quicker assumption of functions. It has been alluded, this specific procedure, in order to approve this mechanism. This specific mechanism requires unanimity from member states, those that will integrate in the Council of the European Union through their representatives, and should approve the regulation unanimously after an opinion of the Parliament and the Bank. This unanimity was impossible, apparently, to be acquired in 2013 when it was being negotiated. There are states which are clearly opposed, outright opposed to them, like Sweden, the UK, or Denmark, that didn't want to give up any of their competences. So the consensus solution is the application of a dual system. Euro countries will enter compulsorily. Those that do not have the euro will integrate the banking union only if they request it. I said there's a sort of dragging phenomenon. So what happens in one pillar affects the others. This is what happens with the single resolution mechanism. In Article 4 of 806/2014 regulation, there is a regulation that is adapted to the supervisory mechanism. As to the deposit guarantee mechanism, in the projects to develop it, there is a revision on the subjective point of the supervisory mechanism. So we consolidate the option of integrating the banking union only those members that are euro members. Even if the unification happened only for the euro states, it was open to voluntarily access, if they so want, those that do not have the euro. The close cooperation protocols, with the freedom also to leave the mechanism or the banking union, as much as those member states can leave the union, conditioned only by certain temporal and formal limitations. If they request that they want to leave the banking union, they can leave it. And if a member state doesn't want to join, it can always establish instruments of cooperation between banking authorities, MOUs between the Central European Bank and the board that deals with the national authorities. There is a dual system that is consolidated, those integrated and not in the banking union. This brings about contingencies or problems. The inner market of credit and finance products is being broken, that unity, since they are framed in different intervention mechanisms. In the face of the same situation, the solutions can be divergent. Those member states that are not integrated in the banking union may be tempted to apply supervisory and resolutionary policies which are more flexible, that may facilitate the situation of their banking national sector, either by flexible element or by bankruptcies or the solution of bankruptcies with public funds. There is a lack of solidarity or responsibility in the face of transborder banking crisis. So there are no binding elements like these. There is a reinforcement of the gap between two Europes. There are two banking systems that are unified, that are opposed to the ones that do not have that unification, the boomerang effect. If we don't get the accession of those that are outside the mechanism, we would be in a situation in which differences or asymmetries would be more acute than the departing situation. Knowing this dual regime and the disadvantages that it has, and knowing that the national mechanisms can integrate themselves voluntarily, which are the pros and cons for voluntarily adhering, and what are the political, economic, and institutional factors should be pondered to assess that accession. Advantages. The banking union mechanisms may prevent banking crisis in the future, because the separation from political issues in the European Central Bank may allow to have more rigorous policies to curtail risks and the prevention of new crises. It would bring about more confidence in the banking balances, less or lower profitability, and that improves the results account. There are some synergies as well from the banking union. Supervisors are integrated there. They have their know-how and experience, and there's a better situation as to information. Some authorities that in the past would act country by country, now when it is done from the Central European Bank, will have immediate information on what is happening in each of the member states, coordinated by the same authority. There are other advantages with the reduction of costs to entities. They are under unified criteria, single information elements. This means that they don't require assessment from outside to deal with the needs of the banking situation in each country. Now, those opinions will be unified. And it's the mutualization of the risks, which means reduction of costs to avoid banking crisis. This centralization avoids to contribute public funds, which follow only national interests. From a political point of view of opportunity, it could be interesting for member states to integrate this banking union. Why? Because one that doesn't have the euro will integrate the minute they get into the euro currency. If it is not integrated in the system, that will prevent them to participate in the process of decision. If it is integrated early, it will probably have a say when the decisions will be taken and when they adopt euro as the official currency. The advantages are subject to a degree of contingency and transition period, which is very high. We are in an initial period of the implementation of the mechanism, and there is 8 years, an 8 years deadline. So some of the priorities will be seen in the mid or long term, not immediately. The disadvantages of states to not integrate in the banking union. There's no empirical evidence contrasted enough on how good centralization is. The differences of approach don't allow to extrapolate conclusions. There is a certain fear that the European Central Bank would focus on entities of the highest size, leaving aside those that are less complex or smaller. There is the fear that the Central European Bank or the Single Resolution Board would hire the ones that are best prepared and leaving aside the ones that are not as well prepared to solve the problems. There are some inconsistencies in the mechanism of resolution. Funds are limited. Procedures of resolution to restructure entities are complex, which in critical situations, when they have to be applied, make them inefficient. As I say, this mechanism, apart from being under transitional periods, is not functional so far. It hasn't been implanted the deposit guarantee European system, which reduces the credibility of the model. Apart from these problems, we could speak of the institutional approach. A member state that integrates voluntarily in the banking union and doesn't have the euro will not integrate in the governing council of the ECB, because only those with the euro can participate there. And this governing council is the maximum body in supervisory functions of the banks. Why is that the highest decision-making body? For legal criteria, mainly. David spoke this morning of the doctrine, to the doctrine Meroni doctrine. I don't want to insist on what the Meroni doctrine means, but it means that competences cannot be attributed if they are quite discretionary without giving a number of conditions and criteria that allow to test that the decisions made are conditions by those restrictions and criteria. What happens in the banking area? There are very diverse legal, technical, and other aspects of administrative discretionality. There are many options that are given to authorities so that they decide freely among them. It seems, though, then that this Meroni doctrine could be operative to assign resolution or supervisory mechanisms to entities that are not foreseen in the treaties, like, for instance, the European Central Bank and its governing council. This need of participating institutions and bodies that have that appear in the treaties, to the fact that it is required the participation of the Commission and of the Council of the European Union in all the procedures of resolution, not just the Single Resolution Board. To apply properly the Meroni doctrine, these other institutions should participate. As solutions to these problems, there will be created a supervisory council integrated in the Central European Bank, where representatives from all member states, with or without euro, will participate. This council will prepare decisions of a supervisory nature which are either accepted or rejected by the Governing Council. It has been created a commission of mediation which mediates in cases of confrontation between the Council of Government and the Governing Council and the Supervisory Council. But it is not binding. Its decisions are not binding. As a counterbalance to this, there is the possibility of abandoning the single supervisory mechanism and the banking union. Those that join can always leave. This possibility is de facto limited, in fact. It could be punished by the markets, and it would also force to create supervisory systems and resolution and deposit guarantees in a short period of time, and that should fulfill European Union standards. Knowing pros and cons, they are not necessarily present in the same way in all the member states. They are conditioned by political, economic and other factors. The degree of banking of the economy, the presence of groups of the Eurozone, the impact of the economic crisis, the level of stability, the financial stability, the experience and the means that the national authorities have, or the stability of the banking system. Which are the states that would have more incentives to join? Those that have a high level or a smaller level of integration. The one that have more closer currencies to the euro. Those that don't have funds to face a potential financial crisis. This is the case in cases like Bulgaria and Romania that are more in favor of adhering. Other countries instead, like Sweden or Denmark, are less tempted into joining. They have a consolidated stability, they have strict authorities with supervisory policies, they have reputation, they have sufficient funds to face a banking crisis, they have a situation that makes them not to opt for that accession until the institutional system is not modified. For them, the best would be to wait until joining the euro to integrate the banking union. Lastly, there are other factors of cost-benefit, political issues, the degree of Europeanism, or the will of keeping under control, under national control, the banking system, which is the case that has brought about an upright rejection in Croatia, Hungary, Poland, and Czech Republic. They don't have a static situation. They may vary with changes in the situation, which would modify the factors that we have evaluated. If there is financial instability, the financial cost for a member state is higher for the one that is not a member to the ones that are members. They might reconsider their possibility of adhering those mechanisms. On the other hand, it is quite relevant what will happen with the first country that will join voluntarily this banking union. Because if that initial integration is successful, that would prompt new accessions, a kind of dominoes effect. Why? Because if a member state is integrated, it leaves the bloc of non-integrated states. So a bloc that will lose political power. So the ones that are there will have more incentives to integrate. So it is also a will of avoiding institutional isolation. Apart from these pros and cons, we can say that up until now, no member state has integrated, apart from those of the euro. There is a formal request from Bulgaria, a letter. But this possibility is not so far successful. This lack of interest of member states requires compensatory measures, for instance, regulatory or financial, to motivate those member states that have more disadvantages. On the other hand, from the market point of view, there could be a sort of system of arbiters. If they consider those from outside the Eurozone, they consider that the Eurozone is good, they would transfer to areas covered by the Euro area. Nordea Bank has transferred the offices from Sweden to Finland to be under the umbrella. Is there room for optimism? Well, the dual regime is only transitional. If they wish to integrate in the euro, they will end up integrating the banking union, closing that gap between those two Europes, which are increasingly separate. Some of the convergence criteria are here, which should be fulfilled in order to allow integration in the euro. Price stability, monetary policies, or types of interest rates. This transitional nature of the dual regime is not fully true. Two states, Denmark and the United Kingdom, while it's in the Union, that are not forced to join the euro, because that appears in protocols 15 and 16 that allow those countries to integrate the euro only when they consider it appropriate. They have the competence to say yes or no. Once they comply with all the requirements anyway. So the presence of the two blocks may be permanent. If the United Kingdom leaves and Denmark continues alien to the joining mechanism and doesn't join the euro, would be apart from the others. Conclusions. The banking union means a dual regime for supervisory mechanisms. There are significant and not so significant entities controlled by different subjects. But there are two levels of states, those that are integrated in the banking union and those which are not integrated. This duality, as we have already pointed out, is justified by legal criteria. The Article 127.6 of the Functioning Treaty of the EU is justified or justifies the unanimity required to have supervisory competencies to the BCE or to the ECB. I think I have some time. With this banking union, supervisory frameworks of a different nature are kept. This impacts in the financial services sector. As I said, this is means, in a way, the bankruptcy of this market. It is also the proof of two different Europes, one which is more integrated, and another Europe of member states non-integrated in the euro and not integrating these mechanisms. Two different Europes. The optional accession mechanism that is offered to those member states hasn't had the effects that were expected, except for Bulgaria that has presented its request. No other member state has applied. This depends on different factors to keep nationalist and protectionist element, to keep the national system But it means also that they cannot participate in the higher body of supervisory nature. They cannot participate in decisions, so they won't be tempted into joining or to join the mechanisms, because they are not going to participate if they are not in the euro anyway. Which is the relevant institution? The European Banking Authority is a specifically created agency to promote convergence of the supervisory practices of all member states. Why is it relevant during this transitional period? Because it can promote convergence for members that are integrated and non-integrated in the European Banking Union. As a final conclusion, because the time is passing. There is a need of a reform of the treaties, which is not possible in this present situation. It would be like a Pandora box measure. The reform would allow to solve some of the problems alluded to. The attribution of competences to a body different from the governing council of the European Central Bank, and that would not mean discrimination against those that are not in the euro. In the resolution area, it could not be. It might be decided that the Commission and other authorities shouldn't participate in the process. And in this case, it would be necessary to act quite rapidly to avoid crisis and losses. I'm sorry to have bored you, but I have kept to the time, and I hope I can resolve the doubts that you may have.
Thank you, Javi. Just stay there. I think it's easier. I think you haven't bored us at all. I mean, you have introduced us into a topic which is not that widely talked about, isn't it? And but on the other hand, at least in the Eurozone, it's of absolute importance, you know, even if we don't talk about it every day. Other questions?
Yeah, thanks a lot, because I think it's really a brilliant presentation and completely different from the one we listened this morning, but fully integrated and complementary to the debate on the future of the European Union. I have actually a question. Well, you identified this cleavage within the European Banking Union, so those member states who are in the banking union, those member states who are not part of a banking union. I would like to add a second cleavage, which is within the banking union, between what you have actually mentioned, what I call the so-called creditor countries or the fiscal consolidated country, let's say, with a strong monitored banking system in the north, and those member states in the south, which are to which, let's say, another kind of judgment is attributed in terms of stability of the banking system. And the reason why the European Deposit Insurance Scheme has not been approved is exactly because of this prejudice and this cleavage. Indeed, I do think that an EDIS is absolutely necessary in order to complete with the last pillar, the banking union, and to show the most important thing that we are discussing about during this seminar, meaning solidarity and sharing responsibility. And when it comes to solidarity and sharing of risks, thinking about the Eurobonds and the EDIS in this case, then it comes again the division between Germany, Netherlands, above all, and the southern countries. So what's your take on this debate, and what do you think about that? Thanks.
Muchas gracias, Francesco, por tu pregunta.
Thank you very much, Francesco, for your question. and because that will enable me to talk about one of the topics that I didn't have the time to talk. He's talking about the European Deposit Insurance Scheme, EDIS. I said it is absolutely important, necessary. It has two deposits, guarantee and resolution, but we need the deposit insurance scheme. And the Eurogroup will be talking about those issues. And after that meeting of the Eurogroup, the proposals will be rejected or accepted tomorrow at the Euro Summit. We don't know what they will say yesterday, but in the preparatory meeting, they said, it was said that we need to create special working groups so that we can design how this European Deposit Insurance Scheme will be. Like, as you were saying, the Netherlands is against sharing risks. So, as the way it looks now, for the short term, we won't be having a European Deposit Insurance Scheme. You were talking about the Eurobonds, but I think it's going to be discarded. Spain and Italy are constantly claiming to have Eurobonds, but some northern countries are blatantly rejecting it. So probably there will be an intermediate solution that won't satisfy either of them, either of the group. So some intermediate bonds created by banks will be issued. So a bank will issue a bond which will combine the equity of several member states. So it's not a mutualization of the debt, an equal mutualization of the debt, but it will be treated as sovereign debt. So it won't solve the problem, but at least will calm the countries. So it will cooperate, it will promote the use of this type of intermediate mutualization by the market. In the meeting of the Eurogroup of the 13th of June, they said there was a beginning of an agreement to set up a common budget for the Eurozone. So there is a bit of a consensus that this budget is needed, but there is no consensus in the contents of the budget. And when? Only when the fiscal compact is expired, or only if all the member states need it, and whether the definition is not clear. So we have to see what happens tomorrow, but I wouldn't say in the short term we will have a common budget for the Eurozone, but we can be optimistic about some point. At least the resolution mechanism that I've been talking about has a single fund with 55,000 million euros. The experts don't think it is enough, so we need a fiscal backstop. It's like a security network that has to be lent by banks in case that fund will be depleted. So that possibility to fund it will be taken from the European Stability Mechanism, and that has been already agreed. So the direct capitalization can be done through the MEDE. So we expect it to be fully operational in 2020, and I am optimistic. But for the rest of the measures that imply more integration, be it fiscal integration, and especially if it's linked to solidarity, the northern countries reject it.
Okay, further questions? Then let me have a question here. We have got a new government in Italy, which at least openly talks about rising the debts of the country, the national debts, significantly. What possibilities are there within the banking union, the central bank, to, well, maybe to spoil these plans?
Bueno, como apunta con malicia
Well, as Jürgen mischievously says, yes, we do have, of course, the rejection, the opposition by the northern countries, because, of course, they don't want to mutualize the risks with countries that, according to them, are not reliable or that are going through complicated political situations. So the central bank, when there is this type of divergences, since there is no central institution, and there is no fiscal procedure, the European Bank decided to set up sui generis solutions, very imaginative. As you might know, in the European Union, it is not allowed for not the European Union, the banking union, the speaker corrects himself, you cannot monetize debt. The European Central Bank and the national central banks of the countries of the Eurozone cannot buy public debts in the primary markets. This is something you can do in the UK, the US, and Japan, but not in the Eurozone. So the European Central Bank has very imaginative solutions. For example, it has developed programs to buy assets. So since you cannot buy that debt in the primary market, the European Central Bank could buy it in the secondary market. That was a way to fund the banks. And another imaginative solution, they have specially funded banks through specific schemes, so the banks could buy this public debt from peripheral countries. So in the absence of stable mechanisms, the European Central Bank has circumvented this prohibition and have tried to find alternative solutions. But because without this possibility, these imaginative solutions, probably many more banks in Italy and Spain would have gone bankrupt. If they continue to forbid that, probably they will continue to do so. So we think that the banking institutions, the banks are private companies. Don't you think that there hasn't been a conflict in terms of, well, the state has been rescuing private companies with public money? Of course. The banking institutions, of course, are private institutions. They should have free competition. If they go bankrupt, they should be left bankrupt. Those are liberal procedures, and they should use they should undergo every mechanism available in the market. And this could be done with very small banks. The problem is that we have enormous, huge banks. For example, think of the Santander Bank or banks that are present in many member states or that provide relevant services with pending payment services. Imagine what would happen if it went bankrupt. What would happen with all the payment orders that are pending? Sorry. I don't know if you know the Madrid Bank. It was originally in Andorra, and it had many clients, many customers, a portfolio of clients with a lot of money. But it was a small bank, and it didn't affect a significant portion of the society, so it was left alone, and it went bankrupt. But maybe the same could not have been done with Bankia. It could have gone to the liquidation process and go bankrupt. But the assets were around 280,000 million euros, and maybe by selling the assets they could have taken back 150,000 million. And they would have reimbursed the investors and the people who had deposited their money there, because they think their money is guaranteed. But yes, it is guaranteed by some limited funds. So that's why the government decided that they shouldn't be left on their own. They should be rescued because it affected many people. There are some criteria and resolutions by the Commission that sets out how to help the bank to try and avoid the granting of illegal funds.
The amount of questions is obviously pretty limited, and we've still got about 30 minutes time. I'd like to broaden the perspective a bit and ask you folks some questions or ask you for comments. We had been talking about cleavages between, for instance, the Euro. You stay here. Between the Eurozone and the member states of the European Union without having the euro as a currency. There's another cleavage system within the European Union, that's the Schengen area. There are member states part of the Schengen area and member states not part of the Schengen area, and there are even non-member states part of the Schengen area, which makes it even more complicated. I was talking yesterday about the possibility or maybe the option of modernizing, adjusting the structures of the European Union a bit, making it more flexible with regard to the existing member states and potential further member states. Because, I mean, there are other nations standing in the queue want to become member of the European Union. And I don't see cooperation easier with even more member states. So might it be an option to get more flexibility within the structures of the European Union by creating different, a European Union of different speeds? I mean, it's an old plan which has already been developed in the early 90s, for instance, the European avant-garde, or whatever you might call it, Europe of different speeds. But mightn't it be a way to improve cooperation within the European Union to reach targets, actually, at least among smaller groups, to create certain circles, let's say an inner circle of which is to a large extent integrated, a larger circle as a free trade area, which would allow these states to be member of the European Union, which are just interested in economic cooperation, and they don't have to participate in political cooperation. And maybe even a third circle of associated states for improving cooperation. For me, it could be an option, a way out of the current crisis, because it's very difficult to reach unanimity within 27 or 28 or even 30 member states. I mean, we've got the problem right now. We can't reach unanimity. So it might be easier in smaller groups. That was a question, my question, which I want to ask you, folks.
I just react just because it's a free and open discussion.
Yeah.
Well, I've never believed so much in two speeds Europe, free speeds Europe, four speeds Europe, because it brings me too much to the idea that it's like, okay, we create an economic union, then we create a political union, as if the two different unions are, so to say, divided. There is a sort of illusion, not your illusion, but an illusion that we could work as a separated group, as if there won't be spillover effects on other member states. I mean, in his brilliant presentation, Javier said when they decided to create the banking union and excluded some member states, the idea was that, well, in the end, someone will enter in the banking union, but then in the end it didn't happen. But the spillover effect that it might be between countries are still there and are still problematic. I mean, my perspective is that two speeds Europe just delay problems to a certain extent. So either we go together or we do not. So when Juncker himself he proposed. In 2017, in the white paper of the European Commission, the possibility to establish different and two speeds Europe, so to go farther with those who want to go farther, or to stay at the same place where we are now, or to integrate, further integrate together. Well, I know that that Germany, for example, was kind of likely to support the idea of a multi-speed Europe. Mario Telò, who is one of the most important professors of European integration, Italian professor of European integration, he developed a theory on he theorized over the possibility of two-speed Europe. I think it's really problematic and brings just delay the problem.
Thank you very much. Speaking of these two levels Europe or multi-speed Europe or variable geometry Europe, as well as you can call it, I think that as he has exposed brilliantly, we have certain sectors in which we already have these two speeds Europe. For example, I'm thinking about the mechanism of enhanced cooperation in the treaties of the European Union. We have an European Defence Agency, and it's just for certain states because others don't participate. Last year was approved after a lot of difficulties the European Public Prosecutor Office, okay, to defend the interest of the economic interest of the European Union, and there's some proposals to extend it to other crimes. So we have examples of this multi-level, multi-speed Europe in certain practices, in certain areas, and well, it's the only way that you have for integration when you have some obstacles, as you said, to the unanimity vote in the institutions. I think that that's better than nothing, I think.
At least it allows progress to a certain extent, isn't it? And it's true, I fully agree. I mean, we already have got these groups within the European Union. My question was, should we extend the system? Let's say, for instance, for foreign policy and security matters. Yeah, we've got the European Defence Agency, all right, but we could discuss about the efficiency of this agency. It's very difficult. I know the European Defence Agency pretty well, but it's torn between different tiers within the European Union. It's difficult to find a way. It's improving. It's cooperation with the member states. But here again, we've got the European Council thing, which is in charge for the common defense and security policy. That's the problem, isn't it? European Defence Agency is one thing. It's an expression of the importance of this sector, but it's still part of the European Council and part of unanimity. That's a problem in it, I think. So my idea is that it might improve again cooperation in security matters, defense and security matters, which is of importance for the European Union, as we have heard this morning, with regard to Frontex, and with regard to the whole problem outside the borders of the European Union. And it makes me feel sick sometimes if I don't see progress somewhere out there on the horizon, in this matter, because I mean, standstill doesn't find solutions. That's as easy as it is. Thank you.
I've always enjoyed looking at the European Union from the point of view of the prisoner's dilemma. When I'm not an expert, but I like the idea of understanding that you're meant to be finding a common interest by which maybe everybody is not going to be happy, but it's the best results that you can have for the majority or for the, so the idea of multi-speed, in the end, how do you differentiate it really from sort of cherry picking and, well, I like this bit, but I don't want this bit. And in the end, everybody is just sort of deciding what's in their own national interest. If I go forward, it's because it's nationally my interest. If I don't, then it's because it isn't. And then you kind of lose and undermine the idea beneath the project of finding a common interest. And sometimes you have to go for it even if you don't want to, because you get other things from the project, because everybody can't just choose. Of course, we can see this with Brexit, so that we're not meant to be cherry picking.
But don't we have cherry packing right now, all right? When I look, for instance, at the role of Denmark or Sweden with regard to our common currency of the euro. I mean, as far as I am informed, the Danish crown is attached to the euro, isn't it? But they still have got their own central bank, that's it. So this is kind of cherry picking, all right, isn't it? Yeah. The question is, how far do we go, or is there a risk of losing the ties? That's the problem, you know. But standstill. That's this metaphor of Guy Verhofstadt, or I think it was him. I mean, it's integration process is like riding a bicycle. If you don't bike any longer, you will fall aside. Yeah, that's it. That's the question. What do we want? We can't find a solution here, you know. I just wanted to provoke you a bit, but now that we've still got 20 minutes left and nobody wants to say anything more, I think we can close this session. Thanking you very much again, Javier, for your brilliant
thank you.
paper. It's, as we have learned by now, it's the economy, stupid, yeah, although it's complex sometimes. Thank you very much for paying attention. And as far as I'm informed, Miguel will come right now and tell us what to do. Yeah.